Welcome to the Pursuing Points podcast, where it's all about the pursuit of credit card points and miles today so that you can travel the world free of charge tomorrow. And now, your host, Peter Foti.
Hello, everyone, and welcome to the 27th Pursuing Points podcast. I'm your host, as always, Peter Foti. I'm super excited about today's show. I'm going to be talking about a topic that's been making the waves, so to speak, on social media and on YouTube and some blogs throughout the points community. You may be familiar with it, but I'm excited to sort of give my take and talk through some points. But before we get to that, one housekeeping item. I finally published my first YouTube video. I had been talking about doing such a thing for quite a while on this podcast. I'm thrilled that it finally got done. So I will have a link to it in the description below. I would love it if you check it out. Perhaps subscribe, leave a comment, let me know what I can improve or what types of content you'd like to see in the future. I do have some plans for videos I'm going to make, but if there's something in particular that you'd like to see, feel free to let me know. With that, let's jump right into today's topic. So, for those of you who hadn't guessed, today I'm going to talk about the recent Wall Street Journal article that came out titled, "Rewards Credit Cards Gained a Fanatic Following. Now Banks Are Pulling Back." This sort of sensational article has spawned several more articles from other outlets like Vox and CNBC, and pretty much everybody's talking about it. The summary of the article is that, banks really jumped into the credit card business after the 2008 financial crisis because things like mortgages were down and they needed additional ways to improve their revenue. So they looked to credit cards with big sign-up bonuses to try to lure in customers to spend money, but that hasn't exactly worked out. And whether or not it's exactly worked out is sort of up for debate. Obviously, the companies are doing well. So I think that that's somewhat hyperbolic, but that's sort of the basis of the article. So what I plan to do is I've pulled a few bullet points from the article. I basically want to read the bullet point and then sort of and just talk about it, right? In some cases, I'll try to refute the point. In other cases, I'll give some examples of why this may or may not be a problem. Just sort of talk through it. So the first highlight, and this is a quote from the article, it says, "The ultra-premium rewards of the kind that JP Morgan has championed have turned into financial albatrosses." So this is something that the banks worry about. It says, "Big banks calculated that giant rewards would make consumers spend more, earning the banks more interest in boosting their returns. They calculated wrong. Consumers have figured out how to game the system, spending just enough to earn generous sign-up bonuses, then abandoning the cards in a drawer. Others pay their bill in full and avoid interest charges and late fees." So there's kind of a lot to unpack there, right? First, again, they're saying that these credit cards that we talk about are financial albatrosses, which are they cause the banks anxiety, the fact that they're out there. And I guess this is because people earn all these rewards and then they have this outstanding, basically debt that the bank has to pay off someday when you decide to redeem them. And then it goes on to say, what I think is the most interesting part is that people game the system by spending just enough and then they put the cards in the drawer. Basically, here's my very simple view of that. If you don't want people to put the credit cards in the drawer, what do you have to do? You have to incentivize them to continue to spend money on it after they've unlocked the sign-up bonus, right? Because, the sign-up bonus is the big flashy thing. That's what gets people in the door. The question is, once you get them in the door, what are you going to offer them to get them to stay? And I suppose that in years past, this wasn't a problem, right? That's really what this feels like to me, is banks using old-timey strategies for these sort of newfangled consumers, right? And they resort to calling, people quote unquote gamers and that they game the system. The reality is that people play by the rules, right? And don't get me wrong, if you don't play by the rules, if you do things that are illegal or against terms of service, I really want nothing to do with you. The bank should close your account. And that's a totally separate topic. I think that represents a very, 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 very small percentage of the population. The rest of us, right, they give us these constraints, they give us these bumpers, so to speak, to use like a bowling analogy, and we are just trying to stay within the confines of those in order to maximize our rewards. And really, that's what like all businesses do, right? They're trying to improve cash flow, and so are we. So this idea that like a smart consumer is somehow gaming the system, and that's a bad thing, just seems off to me. So let's get back to this idea of they're abandoning the cards in a drawer and that they don't use them again. Well, that makes sense, right? Like, let's look at a couple cards, right? So I signed up for the Amtrak MasterCard. Why did I sign up for it? I signed up for it because the publicly available sign-up bonus was 20,000 points. But one day, I was booking a train ticket, and they offered me 30,000 points. So there's the glitz and glamour, right? That's the thing that gets you in the door. I see that, and I pounce on it. So I sign up. I spend whatever the required amount was over the next couple months. I get the sign-up bonus. Now, that card's in my drawer. Why is it in my drawer? Well, let's look at the benefits. You get 3x on Amtrak travel. So presumably when I book another train, I'll use it. But that's not enough, right? I don't spend enough money on the Amtrak for it to be worthwhile for Bank of America or Amtrak in this case to have given me so many points. But okay, I'll use it on Amtrak. You get 2x on travel and you get 1x everywhere else. Well, 2x on travel is not very good, right? I have other cards in my wallet that do that or more. As an example, the Chase Sapphire Reserve. But there's a lot of cards that do better than 2x on travel. This doesn't cover any other category, and then you get 1x everywhere else. There is no benefit or bonus for spending a lot of money, right? There are no sort of things that you can unlock once you've hit certain spending thresholds. It doesn't do stuff that other cards don't do, and the other cards that do what it does do it better. So for a $79 annual fee, when it comes time to renew, chances are I'm going to call, ask for a retention bonus, and if they say no, I'll cancel the card. Next would be like the Barclay Aviator, right? You get a 50,000 point sign-up bonus. Great. If you can get a Saver award on American Airlines, 50,000 points is first class round trip. So that's worth $1,000. The annual fee is $95, right? So there's a 10-to-1 spread there. And it doesn't really make fiscal sense for them to give you that if you don't spend money on the card. But why would you spend money on the card? You get 2x on American Airlines purchases. Okay, sure. You'll probably use it when you spend on American, but unless you're spending a lot of money on American, that's not really going to matter. And then you get 1x everywhere else. So I'm not using this card for dining. I'm not using this card for travel. I'm not using this card for entertainment. It's probably going in the drawer. The only silver lining with this card in particular is you get your first check bag free for you and up to like 4 companions, and you get preferred boarding. So now when this annual fee comes up, what you have to ask yourself is, do I get more than $95 in value? Well, in some cases, right, if you have a large family or you often want to check your bags or preferred boarding is very, very valuable to you because you don't buy like first class tickets, maybe you can say it is. For me, I don't check bags. More often than not, I'm going to try and buy myself either into first class or in a preferred seat, like towards the front of the plane, which will offer preferred boarding regardless. And even for the folks who don't, right? If you want to fly an economy and you're looking for the best deal possible, maybe you don't care. And so I guess my point, and don't get me wrong, I could find a lot more examples, but my goal here isn't to shame all of these different products. I just think that this is old-time logic, and I think the consumer is smarter now, right? I think in the past, this idea that you would have multiple credit cards in your wallet was a very fringe idea. You know, when I was younger and I would look around the adults in the room, they might have one credit card that they spend money on, or they might have a couple credit cards, but they had balances. right? So then they were playing the game of like transferring balances to different cards to try to avoid interest payments. And again, that was a long time ago. I think that people are very, very scared of credit card debt these days, right? Because it can be crippling. So they don't want it. They're not afraid to sign up for multiple credit cards, right? This idea of having to manage multiple products may have been more difficult, like when we didn't have online account access and you couldn't pay your bill online, when you were getting paper statements and things like that. But now, if you ever want to check your balance, you just have to open the app on your phone. So like, even for a non-quote-unquote gamer, it really shouldn't be that hard if you want to have 3 credit cards or 4 credit cards to manage them, right? They have apps, they have websites. You can obviously call 24 hours a day in most cases. So, cards like this Barclays Aviator, which was put on by American Airlines, I think that this is very much like a 90s credit card that's still trying to make a name for itself in 2019. I just don't think that that's going to work. But I didn't want to just pull some examples, bad examples, without giving you some good examples. So I picked some cards that I think do this really well, where if you sign up, sure, you're going to get a really good sign-up bonus, and I think you're going to keep spending money on the card year over year. One of them is the Wells Fargo Propel. So I signed up for this. I don't know if it was live on the podcast, but it was 30,000 points, which is $300. But what was super interesting about this card for me was 2 things. One is that you get cell phone protection up to $600. So what does this cause me to do? My AT&T phone bill is now automatically paid with my Wells Fargo Propel. Sure, I only earn 1x, right? So the opportunity cost of putting it on the Freedom Unlimited is that half a point. But I was paying $10 a month for cell phone protection. So in effect, for me personally, this is $120 a year benefit. And from Wells Fargo's perspective, insurance is basically a gamble. If I never make a claim, they're never going to have to pay out, right? So, but it's a win-win for both of us, right? I get the peace of mind and I get to save the money. They get to offer me a perk, which means I'm going to spend, say your AT&T bill is $300 a month if you have a family. You're going to spend $3,600 a year on the card, and unless you make a claim, that's just total profit for them. Also on that card, you get 3x on digital streaming. Not too many cards do this, but for me, what this means is that I automatically pay Spotify, Netflix, Hulu. Those are all just now my subscriptions are all on this card, and they will be in perpetuity unless they remove that benefit. And the best thing is that this card has no annual fee. So sure, this card is like and don't get me wrong, there are many other perks to this card. I would encourage you to read up on it, and I've written some articles on it, but those are the things that, even though I have a really strong wallet with like the Reserve and the Freedom Unlimited and whatnot, those purchases are going to go on this card forever, right? And there's no annual fee. The next would be like the Capital One. I think they're doing really good things with Saver and the Venture One. Saver, I think, is an incredible product. If I was in the cashback mindset, I would certainly have the Capital One Saver card, right? You get $500 when you sign up after you meet the minimum spending. You get 4% on dining and entertainment. Like, I probably should be in the cashback market because I spend most of my money on dining, entertainment, and travel, right? Like, people listening to this that know me, entertainment, tickets to shows, like tickets to sporting events and concerts, that's me all the way. And so for 4%, this idea that I could earn that is huge. So if I had this card, I would put a lot of spending on it. You also get 2% on grocery stores. The Venture One, you get 2 miles on every dollar that you spend, and you can transfer them, right? If Chase ever removed the ability for me to pool points, which they do reference and we'll talk about later, the Venture One would be on the top of the list. All of a sudden, I'm getting 2 miles on every dollar that I spend, right? So I think those are interesting cards that if people sign up for them, I think they're going to continue to use them, right? And these things sort of were spawned out of this like competition that banks are going through as they see what other people are doing, right? Competition breeds innovation in a lot of cases. 2 more, the Uber Visa card. I think this is like, nobody talks about this credit card, But frankly, I think it's really, really good. And for a lot of people, it's probably, if you only want to have one card, this is probably what you should get. You get 4% on dining, 3% on hotel and airfare, 2% on online purchases, 1% everything else. So like for me, again, I'm not really looking for cash back, but if I was, those 4, 3, 2, that's where I spend all my money. Online, travel, and dining. Obviously, we're missing entertainment, but, I would have the saver for that if I was looking for cash back. Right? You get cell phone coverage similar to Wells Fargo. You get a $50 streaming credit if you spend $5,000 in a year, which if this is your only product, that's reasonable. And there's no annual fee. The sign-up bonus is relatively meager. It's only $100, which is one of the reasons I won't sign up for it. I mean, the Saver card, even though I'm not super interested in cash back, I still might sign up for it because it's $500. But like that Uber Visa is a great card. Amazon, a lot of people that I know have the Amazon card. And I'm like, well, why do you have that when you also have these other like travel cards? And they're like, well, because I spent a lot of money on Amazon, right? So like those are two examples where companies did a really good job of understanding their consumer, right? Uber is targeting younger folks. Amazon is targeting their online shoppers who spend money on Amazon. And they have credit cards that can really help you maximize all that spend. Whereas like Amtrak and American Airlines, they're kind of like maybe a couple decades behind, right? If I were them, I would look at Uber and Amazon and say, okay, let's try and do what they're doing, right? Let's try and steal some of their customers. And then the last one I have in this category is the Delta Platinum or the Delta Reserve. And I have this on here just to highlight a single point, which is both of these cards have bonuses when you spend a certain amount, right? So the Platinum, if you spend $25,000 in a calendar year, you get 10,000 MQMs and 10,000 Sky Miles. Now, those MQMs are super valuable because if you value Delta Elite status, the only way you can get it is by flying on a Delta aircraft or meeting those spending requirements, right? So 25,000 gets you 10,000 MQMs, 50,000 gets you another 10,000. So you can start the year with 20,000, which is 5 away from silver status, just for credit card spend. As someone who's had the Platinum card, sure, every dollar that I spend on there, I'm not getting the 1.5 Freedom Unlimited or Ultimate Rewards points that I would get with the Freedom Unlimited, but I really value Delta Elite status. So I could have come up with more examples both for the good and the bad. My point is just to say that, yes, in some cases, the cards, people are going to open them, they're going to put them in a drawer. But I think that should be pretty obvious based on the stated benefits, right? And in other cases, people are going to sign up and continue to use them, again, because of the stated benefits. Let's move on. So the next bullet point I have is, it says, quote, merchants also typically pay higher swipe fees on the more generous Visa and MasterCard rewards cards, typically more than 2.1% of a purchase on premium rewards cards, compared with roughly 1.2 to 1.7 on standard rewards cards. The fees are a primary source of funding for rewards programs, but retailers are trying to lower them. I do think that this could be a problem someday, right? Home Depot, Target, Amazon, basically, this is all sort of an ongoing lawsuit. They want to pay lower merchant fees, right? Because every time you swipe that Chase Sapphire Reserve, it costs them money to accept that. And the way it works is that Visa says, if you want to accept Visa, you have to accept every single Visa card in existence. Same for MasterCard, right? You can't say, oh, I'll take your Visa debit card, but I won't take your Visa Chase Sapphire Reserve. And that's what the merchants are trying to fight in court, is this idea that they have to accept everything or that they have no negotiating power when it comes to how much those fees are. And those fees are actually super important because they really facilitate the rewards programs, right? In the earlier bullet point, it said, people pay their bills in full and avoid interest charges and late fees. Yeah, like you should be. If you want any value out of these miles and points and whatnot, you absolutely need to not be paying interest. But that doesn't mean the bank doesn't make any money off you. Every time you swipe the card, they get paid. So if the merchant fees get lowered, it stands to reason that the rewards will get lowered in lockstep with them, right? The way I was thinking about this is basically this idea of it's like a four-way tug of war, right? On the one side, you have merchants. They want to pay fewer fees because that'll help them make more money. Someone like Amazon, if the fee went from 2.1 to 2%, that's millions of dollars, right, based on their volume. Consumers, right, we want greater rewards. We want more bang for our buck, right? We don't want to leave anything on the table if we can help it. Banks want to offer enough rewards to entice you to spend money, but not too much so that they lose money, right? And then lastly, the payment processors, which are like Visa and MasterCard, and Amex is interesting because they're both a processor and a card issuer. But a payment processor, basically they want both higher fees and more volume, right? Every time you swipe a card, they make money. That's Visa and MasterCard. That's like their whole business. So you have all these four parties pulling, and it'll be interesting to see how it shakes out. You know, for the purposes of this article and this podcast, we don't necessarily have to dive too far into it because the reality is, the lawsuit is going to reveal what it's going to reveal, and then we'll talk about that when the time comes. But I do think that this is an interesting problem, right? And I don't know what the resolution is going to be. I will link to the article which talks about the lawsuit. But certainly if the merchant fees were lowered, I think that would be the thing that would shake up the rewards industry, not the stuff that Wall Street Journal is talking about in this other article. Let's move on. So the next bullet point says, quote, JP Morgan executives debated whether to stop letting cardholders pool together points from multiple cards. And then a spokesperson for JP Morgan says that the bank has no current plans to stop allowing you to pool points. I referenced at the beginning of this podcast that I recently published a YouTube video. My first YouTube video, spoiler, is on this idea of you have multiple Chase products, you pool the points together with either like your reserve or your preferred, and you get the bonus. You know, here's the thing. If they stopped allowing you to do that, one, it opens the door for another card issuer to do the same thing. Now, maybe I'll take my business there. And even if somebody else doesn't do that, it changes the entire value proposition for me and Chase. Right? Now, the Freedom Unlimited isn't necessarily as interesting if I can't pool the points because now I can go get the Capital One Venture card, which earns 2x. Right now, the Freedom Unlimited at 1.5 is at least worth 2.25 with the 50% bonus that you get when you combine it with your reserve points. But if I wasn't able to pool it, I would probably not use it, right? In fact, I know that I wouldn't, right? Like, again, I'm not interested in cash back, so I wouldn't be interested in a card that only offers 1.5%. Right? The whole reason I have that card and why it's like my daily driver for anything that's not bonus spend is because I can combine those points later. And from JP Morgan's perspective, I wouldn't be surprised if this did happen someday, right? I don't know what the economics of all this are. I don't have access to I don't know. So it wouldn't surprise me if it did happen. But again, it would require me to reevaluate. And I think that's the thing. Again, that's one of the common themes here. Assuming that the consumer knows what they're doing and is pretty smart, I think is important, right? I don't know if you could always have said that. And I think for a long time, businesses and banks especially, they just assumed people didn't know what they were doing with their money. But now we have all of these educational mediums, right? We have podcasts, we have YouTube, we have books, we have everything. You can learn about all this stuff, right? You just have to do one Google search and you can learn how to maximize your credit card spend. And this idea that if you take stuff away from people, they're not going to find another way is probably wrong, right? I just don't think that that's how that's going to work. We have a couple more bullet points. So it says, this one will be quick. I mean, basically what it's saying is that banks have been lowering sign-up bonuses since 2017. And they give a few numbers and they say that, we're at 44,000 on average for the first 7 months of 2018. I think you You could tell a lot of lies with different statistics, depending on how you put the numbers together. I don't know what data they gathered. I don't know how they arrived at the numbers they arrived at. I'm not saying that they're wrong, but what I'm saying is I just don't know if I believe that, right? Off the top of my head, Barclays Arrival Plus is at $70,000, which is worth $700. Capital One Saver is $500. The Aviator Red is $50,000. Again, that's like a first class round trip ticket. Both the Sapphire Preferred and Reserve are at $50,000. And then you've got business cards that are over $80,000. And that's not to even mention targeted and other special offers, which can net you points into the six figures in some cases. So I don't know if that's necessarily true. What I do think is true is that companies are experimenting with different sign-up bonuses, right? Where like Discover is saying, we'll double your cash back for the first year, right? American Express on their Gold Card, you got the 20% bonus on the restaurant spend up for the first several months, in addition to some other benefits. Barclays tried to do this last year with a card whose name I'm forgetting. You basically had to spend like $25,000 to get another bonus, but that didn't work, and now they're back to the Arrival Plus because that card was off the market for a little while. So the point is, if you want people to sign up for your product, if you want to be competitive at least, you still need to offer them a pretty significant sign-on bonus. But that's not enough, right? Because people have multiple cards, people can do simple math, and anyone who's interested can understand how to maximize their spending. So I don't really believe this idea that the banks are lowering sign-up bonuses. For that to really happen, they'd have to like all sort of band together, and that would have to be the new normal. But the reality is, when Chase came out with the 100,000 point sign-up bonus, the new normal is like, you really need to come to the table with something significant for people to sign up for your product, right? Again, it's not enough to offer 50,000 points with 1x on every dollar you spend and expect people to keep your product. The last thing I want to talk about is, this is in reference to a consumer that they interviewed for this article, which said he left SPG for Chase after the recent devaluation. And an Amex spokesperson said, we feel confident that the majority of our current SPG Amex card members will get more value out of the card's new value proposition. And Marriott said the card, in this case the SPG, I guess, or the Marriott, the SPG personal card, remains a tremendous value proposition. Yeah, that's just not true, right? So regarding the devaluation, just for context, the SPG personal credit card by Amex was long heralded as one of, if not the best, rewards credit cards in the business, right? Now, that only earned 1 point per dollar, but those points were super valuable, right? You had points and cash redemptions at Starwood properties. You could transfer those points to airlines. And you'd get a 5,000 point bonus for every 20,000 you transferred, right? Which meant that basically you were earning 1.25 airline miles on every dollar that you spend, which was better than any card available. And of course, you had SPG moments. There was different hotel redemptions. When SPG and Marriott merged, 1 SPG point became 3 Marriott points. Okay, what that means is that for the card to have maintained its value proposition, not even increased it, to maintain its existing value proposition, that same card needed to now earn 3 points per dollar at a base level. But it earns 2. So it's a 33% devaluation from what we had before. And to tell yourself that it's still a tremendous value proposition, that's fine, right? You can tell yourself that internally, but know that the consumer, again, the consumer is not dumb. People will figure this stuff out, and you just can't, and it's not nefarious, right? Like this is what companies do. This is what like Apple does. They say, oh, we have the fastest iPhone ever. Okay, well, relative to what? And why does that matter to me? People, again, we go back to this like 4-way tug of war. Consumers, we want more rewards. We want more for our dollar. If you can give us that, we will do business with you. And if you can't, we'll look elsewhere. Right? So, bottom line is, I don't think credit card rewards are coming to an end. And of course, yes, I do have a vested interest in saying that. Not because this podcast makes any money, but just because, my lifestyle is like credit cards are something I'm constantly thinking about, right? And like how to maximize rewards and whatnot. So no, I don't want to see them go away. But I just don't see that happening, right? As long as unless all the banks merge, which would be terrible, and then one bank has like a monopoly on credit cards, which hopefully would never happen because we have, hopefully, the government would step in that case. But, unless that happens someday, as long as there's competition, and as long as we have new banks coming up, I don't think rewards cards are going anywhere. I don't really think that banks are pulling back. In fact, if you look at any of the stuff that I've referenced today, both in terms of some of the great rewards from some of these lesser known cards or some of these huge sign-up bonuses from even the more well-known stock cards, it's as competitive and as thriving a business now as it's ever been. And I just don't see that slowing down. Right? American Express, when the Sapphire Reserve came out, they said, this is a full frontal assault on our Amex Platinum. So what did they do? They were forced to go back to the drawing board and say, okay, how can we improve this product? Right? And they added the Uber credit, right? And they added additional benefits. Granted, they did increase the annual fee, which is unfortunate. But they made the card more appealing. And a lot of people, right? That's still top of wallet for a lot of people, the Amex Platinum. It's not for me because I don't have it, right? Top of wallet for me is the Chase Reserve, Sapphire Reserve. And that will continue to be top of wallet for me until they reduce the benefits, which they may feel like it makes fiscal sense for them to do, but hopefully they'll, calculate the expected impact of people leaving the product. Anyway, I would love to get your thoughts and opinions on all of this. I've been talking at this microphone now for 32 minutes, which is not bad, but that's enough for me. So hop on pursuingpoints.com. Send me an email if you have questions, comments, concerns. I would love it if you check out YouTube. I'll have links to message me on Instagram and Twitter as well. I do appreciate your feedback. I read all your emails. I try to respond to as many as possible. And again, if you have questions or stuff you want me to talk about in the future, just let me know. And that's all for today. Thanks so much for listening.